All right, Happy New Year, everyone. To celebrate the new year, we're gonna do a video in the garden. So I hope you like the sound of birds. Anyways, I did not trade yesterday. This is just a review of the setups that could have been there yesterday if you were trading. There was potentially one valid trade for one win for a total of plus 2R. Which I'll go over, and I'll also go over two potential setups that could have been there, but they would have ended up in a loss. But following my rules, they would have been avoided. I'll also go over just some new indicators I'm playing with that make life a bit easier when trading this model. And then lastly, I'll touch on an extra confluence / bias I'm playing with, still backtesting, that could potentially filter out different setups so we have a higher probability of getting a win. All right. First, just a super quick 2-second review of the strategy. Well, actually, if you were watching the last couple videos, you would realize that we are no longer trading engulfing candles as an entry model. So we can get rid of this. Nice and simple. Now the model is just inverse fair value gaps. Anyways, okay, so it's super quick. The model is just, we look for virgin wicks. What is a virgin wick? Virgin wick is a wick that has not been touched before. So that's a virgin wick, that's a virgin wick, that's a virgin wick. If you just draw a line all the way to the right, it doesn't touch anything, that's a virgin wick. So this was a virgin wick that just got closed through. Yeah, so we look for virgin wicks to get closed through by a Chad candle, and then we mark off that wick level as our point of interest, as you can see here. Then we drop down to the 1 minute, and in that next hour, we want to look for a wick down. Well, on the 1 minute, it's actually a close below the point of interest, and then a close back above with the presence of an inverse fair value gap. And that would be our confirmation to enter upon closing above the POI, and then we get our nice profits. So that's the strategy in a nutshell, and I'll just show you an example from yesterday that would have been a super clean win. So this was actually during New York PM, so Wednesday 31st of December, 12 PM. Personally, I don't trade PM, so I wouldn't have taken this anyway, but it's a nice example that I'll go through. So we have this 11 AM candle that closed here, closing through this virgin wick, okay? So that becomes our point of interest now. Oops. So that becomes your bearish point of interest. And we are now looking for shorts from that area. So we drop down to the 1 minute, and we can start looking for our short model to play out from 12 PM. So first we need to get a close above the point of interest. Bang, there you go, we get a close above. Then we need to look for a close back below, along with the presence of an inverse fair value gap. Bang, there you go. There is your confirmed inverse fair value gap and close back below the point of interest. Oh, you might also notice this thing on the right. This is just what I was talking about. This is called the CCT by Master Chi. I'll leave a link in the description below. But it essentially just shows the higher time frame candles, so you don't have to switch back and forth between the 1 hour and the 1 minute. But it also shows virgin wick levels that have been closed through. So you can see here, this red line is drawn by the indicator. I'm talking to the dude right now to get him to see if we can also just get it to draw the line on the actual chart itself within the 1 hour. But yeah, this is what it looks like for now. This is just what I'm playing with. Yeah, it's just like an upgraded version of the ICT high time frame candle indicator, but it just draws the virgin wick levels as well. Anyways, back to this trade. Yeah, so we get an inverse fair value gap back below, and then we will put our stop just above those highs, and there's a bunch of liquidity we can target down here. But yeah, going all the way down there, that would be 2.8R. I personally cap my profits at 2R per trade because I would rather get a higher win rate than go for the big trades. So I'll just put it there, and yeah, you can put your stop all the way up there because there's quite a lot of room to work with in terms of the target. So we can be a bit more lenient with the stop loss. So it's a bit of give and take when determining the stop loss and take profits. But yeah, this was super nice. Pretty much a zero drawdown. Goes to your TP pretty easy. So that was the one clean trade of the day, and I'll also just go over 2 other trades that were losses, where the entry model kind of presented itself, but not really. But I'll go over why. Okay, so this was gold on New York AM, so 8 AM. So at 8 AM. At 8 AM, we get this really strong Chad candle closing through this virgin wick, this virgin wick, this virgin wick, and this virgin wick, right? So these are now your bullish points of interest. There. But yeah, like I was saying, this indicator, so if I delete these lines, this indicator even just draws it for you. So if I drop down to the 1 minute, let me just get rid of these lines I just drew temporarily. You can see this is what it looks like on the 1 hour. This is the 1 minute chart, and you can just see nice visually that we had this Chad candle create all these virgin wick levels, all these points of interest. But I digress. Let's just go with the manual drawings for now, just so you understand the model better. So yeah, we have all these bullish points of interest, and we can start looking for an entry model from 9 AM. Okay, boom, 1 hour candle is closed. We now look for a close below any of these points of interest, and then a close back above, followed by the presence of an inverse fair value gap. Let me just pause the video because there's a plane and it might be super loud. All right, the plane is gone, so we should be good now. Yeah, okay, so we're looking for a 1 minute close below any of our points of interest, and then a close back above with the presence of an inverse fair value gap. Okay, so we have a close below. Now we're just looking for an inverse fair value gap. Okay, nothing yet, but we keep going lower. So this second POI has not been penetrated yet, has not been closed below yet, so we're still just looking for a close above this one. Boom, okay, so also you also notice that this inverse fair value gap was printed automatically. I did not have to draw it. And that is just from this inverse fair value gap pro toolkit by JMac. I will also leave a link in the description. It is also free. But yeah, I've been really liking this lately because now that my entry model is strictly an inverse fair value gap entry, we no longer use SISTs or engulfing candles. Having this indicator is just super handy because I don't have to manually look for fair value gaps. It just shows me straight away. So it's super handy. Play with it if you like. Yeah, I'll leave a link below. But yeah, so at this moment here, we do get a close back above with the presence of an inverse fair value gap. So this could potentially be an entry. But the reason I would not take this is because there isn't a super nice draw on liquidity. So these are the highs that you would target, right? And yeah, if you were to put your stop there, that's 0.7R. If you were to put it that low, it's 0.82R. Even if you got super greedy and just put it right below the entry candle, 1.6R. It's okay, but it's like you got to get really greedy with it. So yeah, not a super high probability trade, and yeah, for that reason I wouldn't take it. You end up getting stopped out anyways, and it just ends up being chop. So you do end up taking it, but taking the liquidity, but you would have to get stopped out. So yeah, and yeah, by the time you get a secondary chance to enter, the risk reward's just not there. So yeah, better to avoid this trade. And then I'll just go over another example. This is NQ during London yesterday. Okay. So we had this nice, huge 1 hour candle closing down, closing through this virgin wick, and this virgin wick. So those are your 3 bearish points of interest. Drop down to the 1 minute. We can start looking for our entry model from 4 o'clock. So boom, we get a close above the first one, boom, get a close above the second one. And then there is your inverse fair value gap, confirmed. So now all we need is a close below a point of interest, and that would be your trigger to enter. Boom, there. So you should actually enter there. I don't know why my thing here is there, but anyway, you can enter there, put your stop there, targeting these lows, but of course capping it at 2R. And how does it go? Just chops around for a long time actually. But yeah, the hour ends here, 5 a.m. And I would actually close this in profits, because I would manually close all of my trades at the end of every hour, because my model, the way I trade this model is POIs are only valid for the hour that they are created. So the candle ends there. Yeah, okay, so 1.37R. Not bad, still a win, but yeah, the reason I would not take this is, and this is also something I'm testing out, is, let me just get rid of these lines. So I'm playing with this, it's called standard deviation plus, and essentially what it does is, let me get rid of everything else actually. It plots the high and the low of the last 4 hour candle. So right now I've got it on every 4 hours. So what it does is it takes the last 4 hour candle and it gets the high and the low. So let's imagine this was the last 4 hour candle. It takes the high and the low and plots them out for the next 4 hours, along with the equilibrium, which is just the midpoint. And so what I'm playing with is not taking shorts below the low, because that shows that we're really overextended. And the EQ, which is like the middle point of the last 4 hour candle, kind of acts like a magnet. So for that reason, I wouldn't short below the lows and I wouldn't long below the highs, because that means we're already pretty overextended. But let me just go to any random bar and show you. Yeah, so this is where the 4 hour candle opened, 2 p.m. And so for the last 4 hour candle, this is the high of the last 4 hour candle, this is the low of the last 4 hour candle. And so you just see the EQ acts like a magnet. Price doesn't want to go too far away from the EQ. If it gets too high, it wants to come back to the middle, see? When it gets too high, it doesn't want to go too much higher. Once it goes past the previous 4 hour candle's high, it likes to come back to the middle. New 4 hour candle, let's have a look. See? It will temporarily sweep the high, Like if you understand ICT and liquidity concepts, this will make a lot of sense to you. But if you're new, a good way to think of it is just price likes to take the previous 4-hour candles highs or lows and then come back to the middle. Just think of the middle EQ line, the equilibrium, as a magnet. So yeah, this is something I'm playing with as an extra confluence or like a bias. Just thinking of the EQ as a magnet and not taking shorts below the low, because that's just lower probability, and not taking longs above the high of the last 4-hour candle, because that's lower probability. But yeah, it's pretty cool to watch if you just play around with this indicator. I'll leave a link in the description as well. It's not always perfect, but most of the time, price doesn't like to go too far above the high and doesn't like to go too far below the low. And it always seems to come back towards the middle, towards the EQ. But yeah, that's just something I'm playing with, and it is something I'm going to do a bunch of back testing with over these next few days, and I'll keep you guys updated on what I find. But so far it's been pretty promising. It keeps you out of low probability trades. But yeah, that was it for today. Hope you guys had a nice break, a nice new year, and yeah, see you next time.